Hello, my name is Brenton Harrison, and we welcome you back to the second installment of our series on financial trends you see on social media. We're going one by one through these trends, and today we're talking about some of the advice that's being thrown around on something called LLC Twitter. Let's get started. We kicked off our series last week on financial trends that you see on social media with a video on investing. Not just investing in how the market actually works, but how it works compared to what you see talked about on social media. And today we're going with the second installment in our series. And we're talking about LLC Twitter. And LLC Twitter is the phenomenon where people are getting online and telling you to start a business, but not for a legitimate business purpose. They're not telling you to do it to break out of the 9-to-5 grind. They're not telling you how to level up in what you're doing on your side hustles. These people are literally telling you how to open a business with no purpose and use that business to take tax deductions for expenses for things you buy in your personal life. So we're going to talk about that trend, what's accurate, what's inaccurate, how it came to be, and what's the takeaway when it comes to your finances. There are a few things more dangerous than when someone tells you something you should do that's really complex, that's lacking in context, right? Like, here's this complex thing, but I'm not going to tell you any of the background information for this complex thing. And it's even more dangerous when that advice is often inaccurate, and even more dangerous when that advice involves money. And if you think there's no forum, no place out there where people would offer such dangerous advice without context, let me introduce you to LLC Twitter. So when PPP loans were first introduced and all these stimulus packages, there were various self-proclaimed financial and accounting professionals who started getting online and telling people how they should just start an LLC because the LLC would solve all their problems and they could use that LLC to immediately turn around and start getting loans related to the stimulus packages. Yeah, look at this. This was shared in good conscience, and he is far from the only offender. Matter of fact, non-credentialed user after non-credentialed user, they were sharing just a dizzying mix of legal and tax advice with little to no context, to the point that the nickname LLC Twitter was born. What's concerning, beyond the fact that most of the stuff that they're telling you is considered fraud, is that the things that they've been telling you have been getting more and more involved. Take a look at this. And if you think this is a case of just one or two rogue people online saying that you should do this, no, this became a thing. Like, I can show you examples of Mercedes dealerships who have been promoting it on their websites. And this is a perfect example of something that has a sliver of truth that's attached to it, but that sliver of truth needs a whole lot of context for you to know how to apply it to your life. It is true that some, but not all, businesses can purchase vehicles and use some of that purchase price as a write-off for their taxes. But I'd say that most people aren't even aware of what a tax write-off is in the first place. A tax deduction, which is also known as a write-off, is a tool that you can use to reduce the amount of income on which you pay taxes. So for example, if you had $100,000 of taxable income and you used a $5,000 write-off, it would reduce your taxable income to $95,000. So even though you actually made $100,000, you're only paying taxes on $95,000. Now, there's a huge difference between saying that something reduces your taxable income by $5,000 and saying that something generates $5,000. Let's say you pay 10% in taxes. If you have a $5,000 reduction in your taxable income, it only saves you $500 in taxes, whereas a $5,000 check is $5,000. What's worse, all write-offs aren't even dollar for dollar. And what that means is if I bought something that's $5,000 and it's a write-off, a dollar for dollar write-off means that this $5,000 purchase reduces my taxable income by $5,000. But not all write-offs work that way. You might have a $5,000 purchase that's only a $1,000 write-off, which means you spent $5,000, but only $1,000 of that was used to reduce your taxable income. Even if you could write off portions of a G-Wagon purchase, and those G-Wagons can run over $150,000, you'd still have to come up with a tremendous amount of money to afford what's left after the write-off, right? Like if you buy a car for $150,000 and you get a $25,000 write-off, there's still $125,000 left at the end of that exchange. I don't know if I can call it a win to have a car that's $150,000 and say, yeah, but I only paid $125,000 for it. And that's even if you're eligible for the write-off. The Mercedes G-Wagon tip comes from a special type of write-off called a Section 167 expense. And it works off of a concept that's basically advancing or getting a front-loaded version of something called depreciation. See, every time that you have something that you buy for a business, like a computer or a car, if you have a landscaping business and you buy a lawnmower, you are buying that thing and you're putting it into use in your business, knowing that it has a limited shelf life, right? Like everything that you purchase for your business won't be around forever. It has a useful life, and at some point in time, it's going to have to be replaced. And the IRS wants to make sure that business owners get the ability to have some benefit for the fact that they have tools that they're using for their business that are decreasing in value. And they give them that benefit by offering them something called depreciation. Depreciation is the concept that says, if I buy that lawnmower from my landscaping business and I keep it for 5 years and I haven't sold it, well, I don't get any value from it. It's decreasing in value in terms of its use to me, but I don't get any benefit. Depreciation says every single year that it decreases in value, we're going to give you a tax write-off to represent the amount of depreciation that you experience. In many cases, the IRS allows you to take a depreciation write-off over a certain period of years based on the type of product you purchase for your business. So you might be able to take depreciation write-offs for a computer over 5 years, whereas purchasing some office furniture could allow you to depreciate its value over 7 years. So we're looking at an example of a business that purchases a laptop and takes depreciation deductions over a 5-year period. So you can see that they bought it for $2,500. It depreciates over 5 years, which means that every single year in this example, which is just an example, they're getting a depreciation write-off of $500. Even though they haven't sold this computer, that $500 represents the amount of decreased value it experienced through the course of the previous year. Now, while taking that depreciation over a long period of time is helpful, there are some big purchases that businesses make where they want that depreciation up front. They want a larger write-off based on the year that they put that tool or product into service. That's why the Section 167 expense is so valuable, because what it does is it allows that business owner who qualifies to take an upfront lump sum write-off of the entire cost of putting it into service. This means that instead of you having to spread out a tax deduction or a write-off, that you could purchase something that's eligible for a 167 deduction, like say a work truck or a G-Wagon Benz, and it would look like this. You purchase the G-Wagon for $150,000 and you get upfront depreciation of the full $150,000. So why the fascination with G-Wagons? It has to do with certain tax write-offs and the fact that if you have a work vehicle that's of a certain weight, you get more of a deduction for it than when you have a lighter vehicle. And a G-Wagon is really heavy. So people have put 2 and 2 together and they've said, well, the G-Wagon meets the weight requirements and I have a business. So if I buy a G-Wagon and I have a business, even if I don't need a G-Wagon, even if my business doesn't actually do anything, I can write off the whole G-Wagon and I'll get a free G-Wagon. That's not the case. Remember that a write-off does not mean you get money. It means that you've just reduced the amount of business income on which you pay taxes. So even if you get a tax benefit for buying in an unbelievably expensive truck, you still have to buy the truck. Next, and this should be obvious, the IRS only lets you take tax deductions for your business if the thing that you're purchasing is used to operate your business. You can't buy things for your personal life and use them as a write-off for your business. If you buy an iPad and you use that iPad to meet with clients in your service-based business, the IRS will probably let you take a write-off for it. If you buy an iPad so that your child can watch Cocomelon while you work in your business, that's not a write-off. That's a personal expense. So if you start an LLC for no reason at all, no business purpose, no intention of having a business purpose, and then you go buy a G-Wagon and you use that G-Wagon price as a write-off for that LLC, you've now crossed the bounds of illegality, and the IRS does not look kindly upon people who have misled them. Lastly, and I think this is just an excellent rule of thumb, when it comes to taxes, if the person giving you the advice can do so in the length of a TikTok video, it should probably be ignored. That's it. I hope this video gave you some insights into the potential dangers of being misleading about why you're taking a tax deduction when it comes time to file your taxes. Again, my name is Brenton Harrison. I hope you're enjoying this series so far on financial trends you see on social media. In next week's installment, we're talking about blessing looms and susus. These are two investing clubs, investing styles, ways to quote unquote multiply your money that started coming on the scene a couple years ago. And in next week's video, we talk about how realistic they are to work, whether they're legal, illegal, and whether it's something you should take advantage of or run away from. I'll see you then.